Everyone loves the idea of passive income, but most new investors fall into the same trap. They chase the highest dividend yield they can find, only to watch their actual portfolio value collapse. If you are blindly buying high-yield stocks, you might be losing money without even realizing it. In this video, I am ranking every major dividend strategy from worst to best. We will break down exactly which methods are yield traps and which ones will actually build you long-term generational wealth. Let us find the right strategy for your money. The yield trap, F tier. Here is where most beginner investors destroy their retirement without ever realizing it. The logic seems airtight. You find a stock paying a 14% dividend yield. You buy it. You collect the income. Simple. Except it isn't simple at all, because that yield is usually not a gift. It is a warning. Here is what is actually happening. When a company's stock price falls sharply, the dividend yield rises automatically. Because yield is just the annual payout divided by the share price, the company hasn't become more generous. It has become more desperate, and the market has already voted on whether that dividend is safe. Consider Walgreens. It carried a nearly 47-year history of consecutive dividend increases. In January 2024, it cut its payout by 48%. By 2025, it suspended the dividend entirely. The yield went from 10% to zero. Or Dow Inc., whose stock price fell nearly 37% in 2025, the year it cut its dividend by 50%, despite a decades-long history of regular cash payments. Or 3M, which had a 67-year dividend track record before making a 40% reduction in 2024. Three household names, three collapses, all preceded by payout ratios well above 100%, meaning these companies were paying out more in dividends than they were actually earning. That is the yield trap. A collapsing business inflates its yield as the stock falls, attracting new buyers at exactly the wrong moment. You are not getting paid income. You are getting your own capital handed back to you in installments while the underlying stock quietly bleeds out. The higher the yield, the louder the distress signal. F tier, avoid. The covered call, craze, D tier. So maybe you've heard the advice, skip the individual stocks entirely and buy a covered call ETF instead. QYLDJEPI. Products like these promise yields of 8%, 10%, sometimes 12% or more without the single stock blow-up risk. That sounds a lot better. And for a very specific type of investor in a very specific market environment, it is better. But for most people building long-term wealth, it is still a trap, just a slower and more sophisticated one. Here is how these products work. The fund buys a basket of stocks and simultaneously sells call options on those positions. The premium collected from those options is what funds the high yield. Neat in theory. The problem is that when you sell a call option, you hand over your right to profit above a certain price. In a flat or declining market, the strategy works fine. In a bull market, it quietly suffocates your returns. QYLD's net asset value declined by roughly 3.72% annually over a measured period, even as the market was rising. That erosion comes directly from the strategy's inability to participate in up days, the very days that drive long-term equity returns. Meanwhile, JEPI, the largest fund in this space with over $45 billion in assets, returned 10.5% over a recent 12-month window. The S&P 500 returned 20.1% over the same period. That gap is the structural cost of the strategy. You are being paid for giving up growth that was already yours. D tier. If this is already reshaping how you think about income investing, hit subscribe and drop a comment below. Tell me which strategy you are currently using, and I will tell you exactly where it sits on this ranking. We have covered the two strategies that destroy wealth fastest, one visibly, one quietly. But the next two tiers are where it gets genuinely complicated because the strategies coming up actually work for some people in some situations. The question is whether you are one of them. Let's find out. The REIT and utility defenders, C tier. REITs and utility companies have been the backbone of income investing for decades, and for good reason. A well-chosen rate can throw off yields of 4% to 7%, backed by real, tangible assets, apartment buildings, commercial properties, data centers, and cell towers. Utility companies offer similar consistency, regulated by the government and deeply woven into the fabric of everyday life. This is not junk, this is real income. So why is it C tier? Because real income and risk-free income are two very different things, and REITs and utilities carry a structural vulnerability that most income investors underestimate severely. Interest rate sensitivity. When rates rise, two things happen simultaneously. The cost of borrowing increases for these businesses, which are often deeply leveraged by nature, and the relative attractiveness of their yield collapses because suddenly a government bond is offering something in the same neighborhood. Investors sell, prices fall, your capital takes the hit. From 2022 onwards, As central banks aggressively raised rates to fight inflation, the U.S. REIT sector fell over 30% from peak to trough. Utility stocks followed a similar path. The income kept flowing, but the capital loss swallowed multiple years of dividends in a single cycle. There is also the tax question. REIT dividends are typically classified as ordinary income rather than qualified dividends, meaning they are taxed at your full marginal rate, not the lower preferential rate reserved for standard dividends. In a taxable account, that difference compounds against you over time. C tier. The income is real. The risks are just underappreciated. The dividend aristocrats, B tier. Now we are in genuinely solid territory. The dividend aristocrats are S&P 500 companies that have increased their dividends every single year for at least 25 consecutive years. These are businesses that raised their payouts through the dot-com crash, through 2008, through the pandemic. The consistency alone is a statement about the quality of the underlying business. Names like Johnson & Johnson, Procter & Gamble, Coca-Cola, and Colgate-Palmolive have built global consumer empires so resilient that cutting the dividend would be almost unthinkable. Johnson & Johnson announced a 4.8% dividend increase in April 2025, marking 63 consecutive years of annual increases. These are not yield traps. These are income machines. The yields are typically modest, somewhere between 2% and 4%, but the growth is reliable, often tracking or exceeding inflation, which is what separates a real income stream from one that erodes your purchasing power quietly over time. So why not S tier? Because safety has a cost. The dividend aristocrats tend to be mature, slow-growth businesses. The kind of explosive capital appreciation that a younger investor needs to build serious wealth over 30 years is largely absent. You are buying stability, and you are paying for it in the form of capped upside. For a retiree needing a predictable income with low volatility, this is close to ideal. For a 30-year-old trying to build a $1 million portfolio, it may not provide enough horsepower. B tier. We have ranked from F all the way up to B, and you can already see the pattern. The higher the starting yield, the more danger you are buying. The safer the strategy, the slower the growth. But what comes next breaks that pattern entirely, because the strategies in A and S tier do something the others cannot. They compound aggressively while paying you to wait. And once you see the numbers, you will not be able to unsee them. The dividend growth powerhouses, a tier. This is where the numbers start working in your favor in a way that is genuinely hard to explain without showing it. Dividend growth investing is not about the yield you earn today. It is about the yield you earn on your original investment in 10 or 20 years. Take a company yielding 2% today with a dividend growing at 10% annually. In 10 years, you will earn nearly 5% on your original cost. In 20 years, over 13%. Your share price has compounded alongside it. The income has beaten inflation, and you have never once chased a dangerous yield to get there. The companies that fit this profile tend to sit in sectors with durable competitive advantages: technology, healthcare, and industrials. Microsoft has grown its dividend at roughly 10% annually, while the stock has multiplied many times over. Apple began paying dividends in 2012 and has raised them consistently ever since. These are not income stocks in the traditional sense. They are compounding engines that happen to pay you along the way. These businesses grow revenue, they grow earnings, and they pass a rising share of that growth back to shareholders every single year. The dividend is not a sign of desperation. It is a signal of confidence. The starting yield is low, often 1% to 2%, and that is exactly the point. You are buying a growing business before the market has fully priced its future income. Patience is the only currency required. A tier. The total return approach, S tier. S tier is not a single product. It is a philosophy. And once you understand it, every other strategy on this list starts to look like a compromise. The total return approach combines 3 wealth-building levers simultaneously: dividend income, dividend growth, and share buybacks. Every dollar a company returns to shareholders, whether as a dividend or as a repurchase that reduces share count and increases the value of every remaining share, is a dollar compounding in your favor. The S&P 500 buyback yield in recent years has hovered around 2% to 3% annually, at a modest dividend yield of 1% to 2% and consistent earnings growth of 7% to 10%, and you have a total return profile that has historically averaged around 10% per year over the long run. No yield traps, no capped upside, no single company blow-up risk. A total return investor does not fixate on the income line. They ask a different question: which businesses are compounding capital most efficiently and returning it most reliably? The answer leads them to quality companies with strong free cash flow, low payout ratios, and a consistent pattern of growing shareholder value through both dividends and buybacks. The dividend is not the destination. It is one of several signals that the business is healthy, growing, and sharing its success with you. When you stop chasing income and start buying quality, the income takes care of itself. S tier. You now know which strategies build wealth and which ones quietly drain it. But knowing the right strategy is only half the battle, because even the best dividend investor in the world can watch their returns disappear into two places they never see coming. One is the tax man. The other is their own age. Both are coming up next. The tax drag. No one talks about this enough, and it is costing investors thousands of dollars they do not realize they are losing. Dividends are taxable. Every time a company pays you, depending on your account type, your country of residence, and the classification of that dividend, the government takes a cut before that money has a chance to compound. In the UK, the dividend allowance has collapsed in recent years, from £5,000 in 2017 to just £500 as of the 2024-25 tax year. Any dividend income above that threshold is taxed at 8.75% for basic rate taxpayers and 33.75% for higher rate taxpayers. In the US, qualified dividends receive a preferential rate of 0% to 20%. Non-qualified dividends, including most REIT distributions, are taxed as ordinary income, which for higher earners can reach 37%. The structural lesson is this: dividend income received inside a tax-advantaged account, an ISA, ASIPP, a 401k, or an IRA, compounds without drag. The same income received in a taxable account is being quietly eroded with every quarterly payment. For a long-term dividend growth investor, holding quality compounders inside sheltered accounts wherever possible is not a minor optimization. It is the difference between a comfortable retirement and a significantly larger one. The strategy matters. The wrapper it sits inside matters almost as much. The age equation. The best dividend strategy at 25 is not the best dividend strategy at 55. This seems obvious, but most investors never actually adjust their approach as their life changes, and the cost of that inertia compounds just as reliably as the portfolio itself. At 20 to 35, time is your primary asset. You do not need the income now. What you need is growth and compounding. This is the phase for total return investing and dividend growth powerhouses. Low starting yields, high growth rates, maximum reinvestment. Every dividend you receive should go straight back into buying more shares. The magic of compounding is not passive. You have to feed it. At 40 to 55, the calculus begins to shift. You are building the bridge between accumulation and distribution. This is where dividend aristocrats start to earn their place in the portfolio, not because the growth opportunities have gone, but because reliability and consistency become increasingly valuable as retirement approaches. At 60 and beyond, income becomes the goal, not the instrument. REITs and utility income streams, which we placed at C tier for growth-oriented investors, become significantly more appropriate here. Covered call income may even have a small role for investors with a specific cash flow need in a shorter investment horizon. The tier rankings are not fixed, they are contextual. The right strategy is always the one that matches where you are in life. One tier list, 9 strategies, but everything we have covered comes down to a single decision that most investors never consciously make. The final verdict is next, and with it, the one portfolio blueprint that ties everything together. The final verdict. Here is the truth this entire ranking has been building toward. There is no single best dividend strategy for every investor. There is only the best strategy for your age, your tax situation, your time horizon, and your willingness to be patient in a world that constantly tempts you with shortcuts. But if you had to build a starting framework, the evidence points in one direction. Avoid yield chasing entirely. Avoid any strategy where the income is funded by capping your own upside. Prioritize quality over immediacy. Own businesses that grow their dividends because their earnings grow, not because they need to attract desperate buyers. For most investors under 50, the total return and dividend growth approaches are the closest thing to a blueprint that exists. Hold them inside tax-advantaged accounts wherever possible. Reinvest every dividend. Resist the urge to check the yield and instead check the payout ratio, the free cash flow coverage, and the consistency of the growth. As you approach and enter retirement, gradually shift weight toward the aristocrats and income-stable assets that match your drawdown needs. The portfolio is not a monument. It should evolve with you. The investors who get rich from dividends are not the ones who find the highest yields. They are the ones who understood what dividends actually represent, a signal that a great business is sharing its compounding success with you. Find those businesses, hold them, let time do what you cannot. If this video changed how you think about income investing, the next one will change how you act on it.